Are you ready?
Ready.
All right, let's go. Kevin here, top 1 financial advisor and best-selling author. We are here to talk about the stock market. And there you have it. The Federal Reserve did raise interest rates by 0.75%, which is what we've been expecting, what we've been talking about on the channel for the last, 5 or 6 days or so. So today I'm going to quickly explain what this means for the market. Obviously, what are some things you should consider doing, and then what this means. Is there still going to be a recession? Is the stock market still going to fall? So I'll give you my thoughts and opinions on those. Now, very briefly, I'm going to rehash what it means that the Federal Reserve is going to raise rates really by the highest percent since like 1994, and why this is such a big deal, what this is supposed to do for the stock market and the economy. I'm going to do it very briefly because I've talked about this every time there's an announcement about a rate hike. This is at least the third one, and again, we're expected to see 6 of these this year. So I don't want to keep repeating myself, but we get new people all the time, so I'm going to very, very briefly do it. All right, so the Federal Reserve, their job is to keep unemployment low and to keep inflation at like 2%. That is their goal, 2%. We found out on Friday the market, or the inflation rate right now, is 8.6, so they have to do something. The way they do this is by changing interest rates. They cut interest rates to get people to go out to spend more. It's why the rate on your savings account drops, and you say, man, the bank's not paying me. I'm gonna take this money, I'm gonna go buy an investment property, I'm gonna go harder into the stock market, I'm gonna go do other stuff because the bank is not paying me. Well, things reverse, and when they raise interest rates like they have this year, it says, well, wait a minute, I can get paid more in my savings account. Let me just go on and put some money here. Let me not go and spend this money as aggressively because loans are getting more expensive. So mortgage rates are, I think, getting close to 6%. My mortgage rate, which I got this house in August, was like less than 3. So it is getting way more expensive to get a loan to buy a home. So home prices are going to start to drop, and they already have. And we've done an entire video, and I actually posted a screenshot here. We did an entire video about how and why the housing market was, now I said crash, but it ain't gonna be what it used to be. Okay, and this was a part of that, and again, we've been on the record and been talking about that for quite a while. So that's what's supposed to happen. The big thing here, for those who may not have been paying attention, earlier this year and at the end of last year, we knew that interest rates were going to rise. This is why initially I was so excited about financials until we heard about a recession. But aside from that, coming into it, the Fed said that we're going to raise interest rates by 0.25%, 0.25%. We're going to slowly kind of raise rates on an incremental basis. When they started doing that earlier this year, they found out that, hey, inflation is not stopping, it's not slowing down. So then they went from 0.25 to 0.5. And we really didn't think it was going to get more aggressive than that until today, where it was up by 0.75. So they are drastically increasing rates to show everybody they are serious about stopping inflation, which is a good thing. It shows that the Federal Reserve does want to stop inflation and that they are paying attention to it. It gives the market a bit of predictability, which is generally a good thing. They say they're going to do something, they do it. They said they're serious about it, and it looks like it, right? This is 3x a raise than what we saw earlier this year. You started at 0.25, now you're at 0.75. We will see what happens next, and then we're going to find out, I think, next month or so, whether or not this is having an impact on inflation. But this is the thing. They're trying to stop people from bidding up the prices on darn near everything. Now, the issue is that that's the only thing the Federal Reserve can do, is to raise interest rates. They can't do anything about supply chain, which is an issue. They can't do anything about the price of oil, which is due to Russia and Ukraine and a bunch of other things. This is the one tool they have, and they're doing the best they can with it. Now, the other side of this debate is that you can raise rates too fast and too quickly and push the economy into a recession. That is a thing that can happen, and is a thing that did happen in the late 70s and 80s. That's what they're trying not to do, which is why they've been kind of slowly raising rates and not just come out and say, hey, 2% increase tomorrow and snap your fingers and just end everything, because that'll put you into recession. They are attempting to avoid that. Now, at this point, We'll see. We won't know officially whether we're in a recession or not until July. And I've done an entire video, I think last week, about how that whole thing is defined. So feel free to go back and check that one out. So that's the inflation piece, or the inflation and the interest rate piece that happened today. Now, the other side of this is how this is going to impact the stock market. Stock market was up today, and I think that was more of a, hey, the Fed is paying attention. They are trying to stop interest rates. Now, that doesn't stop companies like Microsoft being down 24%, Google being down 24%. I'm just picking names. Amazon down 35%, and everything else. That's going to be that, right? That is going to continue to happen for, I don't want to say the foreseeable future, but I don't really see that improving, and I don't expect this to be the point of the market that turns around and everything's going to be fine from here on out. That will start to happen if we start to see inflation come down, which we're not going to know until next month. The other thing is, remember, we still have earnings season that's right around the corner. We're going to find out how companies have been doing this quarter, which is Q2. We don't know yet, but we're going to find that out in early July. So things are still going to be early to mid-July, but things are still going to be a little bit hectic. However, there are a few things you can do. Some of them were talked about, but I want to get a little more specific about what you should be looking for. So remember, I talked about in the previous video, there are two ways you can play this, and I think you should have your eye both now in defense, but also what are the companies you can really snatch up and say, this is how I'm going to get rich, like in the next 5 years, right? Not tomorrow, that's not what I do, but here are the things I can hold on to for the next several years, and this is like buying season for me. So these are just examples. One of these companies I own, one of these I absolutely do not, but here's what I want you to take a look at. So remember about context. I always talk about context when you're looking at investing as a whole. We know interest rates are going up. That is blatantly obvious. That's going to continue to happen until we get inflation back down to 2%. It's going to be a while before we see that, but that is the goal. And I've said before, if you have to borrow money, whether you're an individual, your credit card rates are also going up. If you're looking for a mortgage, that mortgage rate is going to go up. So if you are looking to borrow money, it's going to be more expensive, and it's going to be a lot more taxing for you. It's going to be a little bit more stressful. Unfortunately, that also happens to companies too. So what I am looking at, and what I'm going to continue to look at, I've already talked about insurance companies. I've talked about like a lot of the defensive stuff for our exclusive members and the members only under the Join Now tab. I'm going to give you guys a list this weekend on my top 5 to 10 defensive stocks, and then we're going to go into a few other areas. So if you haven't joined, feel free to join that. Now, the other side of this is, what are the companies I can get at a value, and how do I determine value? Because when the market is down 20% and the stock that I might like is down 40 and something else is down 60, how do I tell? Like that's not a good price, right? It's down by 30 or 40%. So what's good and what's not? Here's what you're gonna take a look at. Now, I've done a video on understanding income statements and balance sheets. So what I want to show you real quick is Intuit. And with Intuit, I want to emphasize here what exactly I'm looking at and how I determine whether this is a company, I currently own this company, why and how this is a company I'm probably going to keep, and why. So take a look right here. This is their most recent quarterly report. You can get this from their website under Investors Relations. You can also get this from the SEC website. So here's what I'm looking at here. This is how much money they made over that quarter. You can see here that I have, this is the previous 9 months from April of 2022. Notice here that their revenue, their net revenue, what they made, has increased from 2021 to 2022. That's pretty solid, okay? And then in 2022, just from just the quarter, not 9 months total, but just the last quarter, you can see you're making more money, okay? Making more money is usually a very good thing, especially given what's going on. People are thinking about a recession, rates are going up, stocks are down left and right, but you're making more money. That tells me you might be okay, right? The market may not see it yet, but you might be okay. So take a look down here. What I'm even more interested in is profit. Your net income, is this positive or negative? This means after you've paid your bills, do you have money at the end of the day or not? And look in here, I can see that last 9 months, okay, so going back 9 months, they were profitable in 2021. You were also even more profitable in 2022. So just shrink it down, look at the last quarter, and again, profitable in 2021, profitable here, and this is ticking up. It's going up just a little bit quarter over quarter and 9 months over the last 9 months. This to me says that you're still growing, people are assuming there's a recession, all that kind of stuff, but you're moving in the right direction, even though the market may not. And Intuit right now, I think it's down 43%. Yeah, down 43.5%. So I already own it. And this tells me that this is one of those tech companies that might still be in a very good spot, even though it doesn't feel great. And it could set me up for the future, because if you can make it now, you're increasing, you're making money, you're still profitable, and you're increasing the rate at which you're making money, you might be all right. You might be right. Also, they are a tax company. Primarily, they do TurboTax and QuickBooks and stuff like that. Recession or not, taxes are going to have to be paid. So they still may be around, and I know they've had some issues as well. So I'm going to compare this to something like Peloton. Now I know Peloton's an easy punching bag, but I just want to make this example very, very obvious for most of us from a financial perspective. Now Peloton is down 76% this year. Just this year they're down 76%. If I go back an entire year, they're down like 91 or so percent from the time I looked at it this morning. So when I come here and look at Peloton's most recent earnings report, here's what I'm looking at and why I say, something like Peloton is probably not going to work. Something like Intuit, I can see why somebody would hold on to it. I can see what you were looking at, and that's not a bad decision based on the information that you have. Whereas Peloton, based on the information that we had, we'll see. All right, so same thing here. I'm looking at revenue. How much money did you make? I'm looking here at total revenue. Okay, so under total revenue, you made money in 2021 over the last 9 months, and then you did make less money. Okay, you go from what is essentially 3 billion, I believe, because these numbers are in millions. Okay, so you made $3 billion, and now you're down to 2. Okay, look quarter over quarter, you made $1.2 billion, and now you're down to less than $1 billion. So we're talking 964 million. The money you are making is shrinking. Okay, something to pay attention to. Then I go all the way down here to net loss. And again, everything in between here, yes, it is important to read and understand and know. Okay, but I'm just illustrating quickly to keep this concise. All right, and the last 9 months from 2021, from April going back 9 months, they were profitable, and then they were not in 2022. You lost a lot of money. Okay, and then if I'm comparing this quarter to last quarter, you lost money during this quarter, $8.6 million, and that increased, and you're losing now $757 million. That is a problem. Okay, so you were already losing money this time last year. 8.6 million, not the worst in the world, but you went from 8.6 million from this period last year to losing $757 million. That is not a good trend. Okay, and something like a Peloton is going to have to borrow, and you're going to have to borrow in a space where rates are going up. These are the types of things that you don't necessarily see by just looking at a quick chart and say, oh, this company is down. And it's why I emphasize it's buying season, but it ain't buying season for Peloton, at least based on what we see now. It might be buying season for Target, maybe. It might be buying season for something like Intuit, maybe. But these numbers and these statistics, this information is not something that you can quickly look on an app and say, oh, it's going up, oh, it's going down. This is one way that you determine that, and you have to sit down and decide, is the economy, is the stock market better for a company like Peloton? If we go into recession, do you think that people are going to buy more Peloton bikes? Probably not. Okay, if we go into a recession, do you think people are going to go to Target more? Maybe, maybe not. You probably have to go anyway for groceries. Are they going to file their taxes? Probably so, right? So these are the types of things that you may want to pay attention to. I don't care if it's Netflix. I don't care if it's Disney. I don't care if it's Intuit. And for context, for those who don't know, I do own Target. I do own Intuit. We'll see if I can hold on to them at the end of this month. But these are the things I'm paying attention to. And this is how you can tell whether or not you want to hold on to something or if it makes sense to kind of get rid of it. And again, this is the stuff that most investors don't do, especially if they're new. Now, I know this can be time consuming. I know looking at all this stuff can be a little hard at first glance. Again, I did an entire video on it. We broke down everything. I'll put that, I guess I'll put it in the description, but you see that we've done a video on it. So feel free to go back and watch that one too. All right, so That is it for me today. If you want the exclusive videos, there's a join now tab right below this, and it's also in the description in case for whatever reason that join now button isn't there. It's $10 a month. We do exclusive videos where we go in deep detail on how you can start to understand these things, as well as Q&A videos. If you ask, it's going to be a video for our members only group, so feel free to join that. All right, that's it for me. I'll talk to you later.